Good morning, and welcome to the Macro Show for Thursday, October 25th. I'm Jesse Root, analyst on the energy team here at Hedgeye, and I'm joined by Hedgeye CEO Keith McCullough. Questions, please place them in the comment section below the video player. With that, turn it over to Keith.
Thanks, Jesse, and good morning. Top three things in my notebook this morning, and thank you for all of you that have joined. Again, we put this up for free. I mean, and education's not free, but again, you can lose a lot of money for what you also get for free on that old wall TV, can't you? First thing I'm going to go through is the top three things. Let's do it. Oversold? Yes, oversold. So we're going to make a call as of yesterday's close. Of course, if you're a subscriber, you know that. So covering some shorts into the close yesterday is the way that we play it. Not getting along the things that we don't like, but again, oversold, I'm going to go through that. Point number two, going to get through bond proxies, which continue to be our faves on the long side. Oh yeah, there's a lot of longs that are working, not the longs that the Wall Street has of on the long side, but it is what it is. And then finally, going to give you a big bullish catalyst, which is tomorrow's GDP number. But first, if you go through the oversold signals and you go through equities globally, it's pretty straightforward to see. Even the Kospi, I think Josephine could show you that chart overnight, engaged in the crash last night. So again, we define a crash as a greater than 20% move. What you'll find in Asian equities is that you have a lot of these. So again, the Kospi is the latest to join the crash after dropping 1.6% overnight. That's down 21%, impaling people that have been buying every damn dip. Guess what? Those weren't dips, okay? Chinese stocks obviously have like a moderate bounce, but the Hang Seng did not bounce. That decline in the Hang Seng down another percent overnight, down 24.6% from where you could have got lassoed in it in January. If you didn't know that the globally synchronized recovery, you can hear the economists now, they're choking on themselves. I mean, Draghi this morning is taking down his forecast. If you watched that, apologies for how boring that was. It's like watching paint dry. All I particularly care about is that these economists continue to react on a lag to all that's happened. But all that's happened is not new news this morning, okay? You don't have to have a CNBC special last night to wake you up. All the risks should have been managed globally 10 months ago, okay? We made the call on China slowing, emerging markets slowing, Europe slowing. That's 10 months old, that news. What is new news is that we're going into quad 4 in Q4. So despite the oversold signals we're going to get in Asian equities, we got a big oversold signal in Italian equities. So what? Italian equities bounce off the oversold signal, like 1%. They're still down, as Draghi would say, 1%, you're up 1%. But you know what you're down? You're still down 14% in a month in Italy, inclusive of that 1% bounce. So what you got to be careful with is the bounce. You learn a lot from the bounce, but what's really important as a short seller at least, or as a risk manager, to cover some of those shorts on oversold signals so that you can be more aggressive shorting the bounce. So that's how we want to be doing this. S&P 500 could bounce 3.9% would get you to the top end of the risk range currently. I have that at 2760. For those of you that don't have a dynamic range that resets on and recalibrates on new data, price, volume, and volatility, please don't stare at the 1 month moving monkey or some kind of like single factor surface area. If you don't know what that is, then you're probably learning something right here and now. But again, the top end of the risk range is almost 4% higher in the S&P 500 with the low end of the range only 1% lower, down at 2630. So there's more actually upside today than downside. That could change tomorrow morning, and that's why the people that tune into this tune into it every morning. All right. Point number two this morning is bond proxies. So again, something awesome happened yesterday. Whether you're long consumer staples, the US dollar, utilities, REITs, these things were all actually up on the day. Okay, not like semiconductor stocks, which is one of our favorite shorts, which we'd reiterated, down 6.7% on the day. The NASDAQ obviously down more than 4%. The Russell 2000 is down like 15.6% since going back to where it peaked in late August. 15.6%. For those of you that can do the math on your friends that bought it up there, you'd have to get up 19% from yesterday's close in the Russell just to get your money back to break even. Yeah, that's math, right? If you're down 15.6, you don't have to be up 15.6 to be back to break even. Okay, so what we'd rather you be doing is buying the damn dips in bond proxies. So again, I just rattled them off, and that's what we really want to be doing. There's a catalyst for that, okay? That's point number three this morning, the GDP number tomorrow. So for all the macro tourists, there will be a grand, I guess a grand party tomorrow morning because you're going to get a damn good GDP number. We, of course, have an accurate GDP number that called all of the upside surprises in GDP for the last 5 quarters. Don't forget that GDP had been accelerating. Had been. Important words there, mucker. Get them right? 9 quarters in a row for GDP. That is a record on a year-over-year basis. with the last 5 of them being the most impressive. We call it Quad 2. So Quad 2 is where interest rates are going up, the financials are going up, technology, consumer discretionary, everything basically that we're short of now. Okay, so that ended in Q3. But Q3, of course it's October, we're in Q4, it's almost the end of October. Q3 data point is tomorrow. So you're going to get this reminiscence of what was. All the old Hedgeye long positions, what were. Okay, so if you go back to that point, again, if we get a big number on GDP, guess who else is going to be tweeting about it? Oh yeah, your favorite tweeter-in-chief. He's going to love that number. He might even preview the number. Okay, so don't worry about that. That's going to be very newsy. Macro tourists are going to jump on it. Maybe that drives us up to what you wouldn't believe this morning, which is, of course, the S&P futures are up like 15, 20 handles, whatever they're up. That they could be up a lot more than that, and then they could reverse again. So that's characteristically a bear market when it's developing. If you don't know what a bear market looks like, look at China, emerging markets, Europe, and now the Russell 2000. But again, the NASDAQ looks like it's pretty close to entering one. A 20% or more decline, that's not too far off. But again, you got to study the bounce, measure and map the catalysts that get you there, and have somebody who's got some kind of a track record that's got at least a better than 50% batting average on getting it in and out of that, as opposed to freaking out after every single move. And those are your top 3 things, all right? We do that every morning, you know? Listening to me rant every morning is not ideal for everyone, but just to give you some levels, what we go into next is go around the world on specific levels of risk and where we would engage in the market. So what we like to do is fade the market. So when the market goes down a lot, we like to buy and cover. When the market goes up a lot, we like to sell and short things. Okay, if that's okay with you, I go both ways, and I like it. I'm still, a middle-aged man who likes to do that. Okay, so just make sure that you understand how to engage with the process. You do not want to be doing what Wall Street's doing, which is effectively having CNBC specials at the low end of the risk range. That's not what you want to be doing. What you want to do is have a special at the end of the month in September when we made the Quad 4 and Q4 call. Josephine, if you could show slide 70, which is today's chart of the day. Today's chart of the day, this is exactly what we told you what to do a month ago, okay? Not like last night, a month ago. The expected value in Quad 4, the best short that you could have in your portfolio is momentum, followed by high beta, followed by tech stocks, which include high beta and momentum, by the way, the Russell. And again, if you look at what you should have been on the long side, low beta stocks, dividend yielders, healthcare stocks, and consumer staple stocks. If that's what you've done this month, you have absolutely crushed it. Okay, I mean crushed. This is like, again, beyond crushed, actually. Look at the bongo board on returns, Josephine, if you could throw that up there. This is the sector returns. Okay, so this doesn't have momentum explicitly on the MTUM ETF, which we don't like. But again, you can see technology is down 10.8% for the month versus something like utilities up 4.9%. If you ran a hedge fund and that was your only position, you could get paid $5.50 for that, okay? So that's about as good as it can get in the Hedgeye process. If you think that I'm going to make that call every month, you're crazier than I am. So again, that's a pretty important call. And again, I'd suggest you get the understanding of what helped us make that call. So again, it's the rate of change in growth and inflation, the 2 most important factors that nobody talks about on old wall TV, going from accelerating to decelerating in rate of change terms. And again, this should not blow your mind. Rate of change terms, you learn that in Canada, at least where I'm from, in the 10th grade. Okay, so again, rate of change, the second derivative calculus. This is really simple stuff in terms of the application of calculus to markets and economic data. But the simplicity of the call is quite simple. Quad 4 is when both growth and inflation are rolling off, in this case, their cycle peaks. All right, so just to give you the risk range on the S&P 500, just to write it down. S&P 500 risk range today, as I pointed out, 2630 is the low end of the range. I've been saying it could easily go to 26 something. Obviously it did. But again, if you get to the top end of the range, it's still lower high at 2760. 2760 versus the all-time closing high of the S&P 500, which is 2930. 2930 is the all-time closing high, so you've had like a 9.4%. This minus that, this minus the closing, yeah, that's about right, okay? So the S&P 500 declines about 9.4%. So you have to be up about 10+% to get back to break even. As I pointed out, whether you're along the NASDAQ Composite Index, that's down minus 12.5%, and the Russell RUT is minus, minus 15.6%, something like that. How do I remember all these numbers? Because I write them down. Every day for the last 20 years, I've been writing them down. So if you think I'm crazy, I think that's a fair argument. People make arguments about me all the time. It is also important to deliberately study the risk of the market so that you can understand when there's something that's destabilizing within the market. So again, this should be a mathematical exercise based on deliberate study, measuring, and mapping. This should not be how the market feels, or what the market's valuation looks like, or where you think it should go, or what you feel about it politically or otherwise. That's not how we do it, okay? That's not the way you should do it. If you do it that way, apologies for whoever the hell told you to do that. That's definitely not the way to do it. Volatility, by the way, which is the most important part of the Hedgeye model. For those of you that don't know what that looks like, just team, if you could flash up, I think it's slide 22 in the current macro deck, as opposed to looking at moving monkeys, for example. You can go to the zoo and do that, or you can watch TV. So again, old wall TV. Price, volume, and volatility would be a much better way to look at it, okay? So that's a basic three-factor model for a modern-day quant, or modern-day quant. You know, I don't want to be called a quant. I just want to be called a guy who does math, okay? So when we think about the volatility of volatility, what's actually happened underneath the hood here, guys, is that, can I draw on this? What's happened underneath the hood here is that the vol of vol now has a range of, call it 17 by 27 on front month VIX, okay? So the vol of vol is dramatically different than when we were bullish. Don't forget, we were bullish on stocks, you would forget if you didn't know me or don't want to know me, for 2.5 years. I mean, we just went bearish on US growth stocks, momentum stocks, all the things that I just showed you on slide 70 of the current macro deck at the end of September, okay? So again, to be bullish enough in that period, we actually had trending volatility. The vol of vol was like 10 by 15. So you had bearish volatility, you had bullish markets. Now you have bullish volatility and you have bearish markets, okay? So most people that just stare at moving monkeys, you know, the 200-day moving average or something ridiculous like that, they're not talking about the number one driver of your emotions, which is volatility. So we want to be on top of that. We want to, again, understand how volatility clusters, how it's episodic and non-trending, but then it becomes trending, okay? That's what we want to talk about. We want to talk about that mathematically. I'm only in my mid-40s. God willing, I'll do this till I'm an old man. But all the old guys on TV, they don't talk about that ever, okay? That's a good thing. Thank them for that. Hopefully they're gainfully employed by their socialist employers for as long as they can be, okay? I digress. What else we got going on over volume. Look at the volume yesterday. So if you're studying price, volume, volatility, please write it down. Study it every day. Look at versus the prior day, versus the 1 month average, versus the 3 month average. And what you can see is the explosion of volume in the day before that, where volume was up like on a day-over-day basis, it was up 41%. Finally, volume went down a little bit versus that number, but in the aggregate, volume's been exploding to the upside on these market capitulation or panic days. So when you want to be covering your shorts, it's a beautiful day to cover shorts when people are panicking in size, puking all over the place. That's what a short seller wants to see. So we saw that yesterday. And again, I told you to cover your shorts yesterday so that you can reshort. Maybe we'll reshort them today. It's probably going to be better to be reshorting stocks that people at Hedgeye don't like. Analysts being, we have 40 analysts, don't forget. I'm not some dude trying to remember 5,000 stocks in my head with one-liners and horns and clowns. What I'm trying to do is, again, pick the stocks that my analysts don't like and pick a good spot in the market. So today would be a wonderful short selling opportunity. You know how the old wall talks about, this is a great buying opportunity at a good PE. No. Today is a wonderful short selling opportunity in Tesla, okay? So you're gonna get a stock that we told you to cover. Both institutional research know it's out there. Real-time alert subscribers obviously covered it if they listened to me. And now I get to short it. So now instead of shorting the S&P 500, which is probably not gonna hit the top end of my range, what I really like to do is shorting things at the top end of the range. Twitter might be at the top end of the range today, Tesla. So again, we're gonna get systematically, hopefully some really good cheerleading of stocks that have gone to the low end of the range, because the only thing that I have left is to reload at the top end of the range. Okay, so if you have questions on that, please engage. What else do I got going on overnight? I mean, look at Japan. Oh my Lord. I mean, we had people go from bullish to bearish Japanese equities. That's the typo. That's the South Korean Kospi with the title saying the Nikkei in Japan. In Japan, the Japanese stocks, again, are down 11.2% in the last month. But again, it wasn't just that breakdown in the Kospi that should have you just reconciling what's happening in the rest of the world, which is it's slowing. If you don't know that the rest of the world is slowing at this point, you're obviously sleeping in a dark cave with no internet connection. Australia down 2.8% overnight, Philippines down 2.3%. Again, write it all down. Study it, measure it, map it. People are like, why is he talking about Philippines? Why is he talking about Australia? I don't care why you're wondering. This is what you do. This is how you do it. If you want to be a professional that does macro across asset classes, you got to do all the countries, write it down, measure and map it, understand where the world's risk is going on a real-time basis. Already talked about Italy on the bounce. The DAX should bounce today. If it doesn't bounce from here, this would be a big problem. But again, I digress on that. Oil, that's another big one. So oil broke trend at Hedgeye last week, and now it's still no bounce. So we're not really seeing a bounce in that one, and that's one of the main leading indicators on why I think interest rates could go back lower, okay? In the very short term, interest rates could pop. I already gave you the catalyst on that. GDP number, and by the way, next week's employment number, we should see some hawkish wage inflation. Again, wage inflation does not equate to headline inflation. For those of you who have not done the work on that, we can jump into the macro deck and again give you all the back tests. But again, there's plenty of times in US history, in fact, most of the time, after the peak of the cycle that headline inflation starts to roll over and wage inflation stays sticky and tight. If you guys look at slide 48 in the current macro deck, you can see that during every recession, every single one, the red bars on slide 48, wages are accelerating into the recession. Why? That's what perpetuates a recession, okay? That's what perpetuates a recession. It doesn't perpetuate up bond yields. So our call is what's along the top line there versus Bond King. Me versus little old mucker versus Goliath. Bond King thinks that rates are going higher. Little mucker thinks they're going lower. CPI is going down, we think. US dollar is going up, wage growth is going up, and you see a margin squeeze at corporations. And when you see a margin squeeze at a corporation, you see their stock go down a lot. Okay, so that's the next phase of this. That's going to roll well into next year, by the way. That's probably one of the most dangerous long-term charts in macro in terms of it. Mean reverting, again, and mean reverting quite quickly. As you can see, the black line, which is profits, has a central tendency to start to head towards the gray line in fairly short order, and that's what causes a lot of corporate risk. Credit risk in the credit market, when people talk to me and say, well, I don't see the credit risk. Well, you didn't get short all the things I told you to get short. Now you're just saying, well, I don't see the credit risk. I see credit risk. I mean, I guess you're not looking at the same thing. It's, as Picasso would say, it's not what you're looking at. It's what you see. When some people look at me, they see a guy they don't like, all right? And I look back and I say, I don't like you either. It's okay. All right. Gold, that's something I might buy. A lot of questions on that.
Lots of questions on gold.
Yeah, people just want me to, we have so many people that have been long gold and body bagged in gold, and we were not bullish on gold. I'm getting ready, but I'm going to take my time. I'm not going to do it when you ask me to. I'm going to do it when my process tells me to. All right, so the biggest headwinds on gold have been a rising dollar in conjunction with rising interest rates. So what you would want to have, and maybe we'll get it in the next week. So again, we have two big catalysts for bond yields to go back to the top end of the range. Isn't there some cognitive dissonance associated with me saying, I like long-term bonds, I think they're going lower, but in the very short term, I have some catalysts that they're going higher. Maintaining two opposing thoughts in your brain and being able to subsist. And that's maybe because I'm a hockey player, I can do that. Really super intelligent people, they can't do that because they're so wedded to what they believe should happen. What I believe should happen over the intermediate to long term, and I'm talking about for 3 months to the next 6, 12 months, is that bond yields have already made their highs and they're going to continue to make lower highs. But in the very short term, an opportunity to buy gold should be on the day that we get a good GDP number or next week when we get some wage inflation. Because what has the highest inverse correlation, in other words, gold's going down when it's going up, is when interest rates have up days. So if you want to do it the way that I want to do it, and as your favorite president would say, believe me, I want to get this right. But I definitely don't listen to a lot of questions that forces me into it. Low end of the range is where I'd like to buy gold. That's 12.16. That's where I'd like to buy gold, okay? Is it at 12.16 this morning? No. So I'm picky and I'm patient and I want to do that. And I'm only picky and patient because I used to not be picky and patient and I used to be worse at this than I am today. Every day I want to get a little less worse, okay? I don't want to, again, engage in what a lot of people have owned and want to own, which is gold, or Bitcoin for that matter. Oh my God, go shoot your, whatever, when you think about that. Bitcoin, we're still bearish on that if you care. What else do we got? And I might go bullish someday on Bitcoin. Again, I'll go both ways on anything. I'll buy corn, I'll buy hogs, I'll buy Bitcoin, I'll buy, I'm just not buying it yet. What else do I got going on for you? Look, German yields down at 40 basis points. Swiss 10-year yield, which I call Anchorman, that's down at, look at this. This is down at, can I get back to my main screen, guys? This one? Yeah. All right. Swissy 10-year, Swiss, let's call it Swissy. The 10-year, you know what it's at this morning, the 10-year yield? Minus 0.06. For those of you who know who my girlfriend is, pink, love pink. My pretend girlfriend. All right, Swissy 10-year yield. That's Anchorman. That's what the world thinks about inflation at this point. That is the number one proxy for global deflationary expectations. Bond King knows that. I know that he knows that. I wouldn't doubt if Bond King's changing his position right now, or in the next week, because he's going to have 2 opportunities to change that position. But again, Bond King or not, everybody knows that once we get into the backside of inflation, as opposed to what inflation's been doing for the last 3 years, which is going straight up, we're going to get falling bond yields. So that's something to be paying attention to. And Mr. Swissy is giving me that signal this morning. JGB's, Japanese government bond yields, down another 2 basis points this morning. That's another one. Maybe a good spot to take some questions.
Yep, we got a bunch of great questions here.
Can't believe I ranted for 21 minutes. The team told me to rant for 20.
Yeah, 21's okay. We have a lot of questions, and by the way, we may go a little over today, so keep them coming in. First one is, any of the high-frequency data that feeds your GDP forecast slowing faster than your algorithms would have predicted?
Capex this morning. All right, here's one. I don't know if you guys have, the team might have the Capex number readily available, but so in the durable goods number this morning. So again, durable goods has a lot of important information. Durable goods ex aircraft and defense is a good proxy for household spending. That actually slowed a little bit from its cycle peak, which is 6.9%. Moreover, the Capex number, I don't know if you guys can throw that chart up. If we do have Capex, well, that's okay that we don't, because you'll just have to take my word for it. Capex, we have it in the current macro deck. I'll be damned if this 120 slides are reasons why we're in quad 4, which we made that call a month ago today. Did I say that? Yes, I did say that. Capex, there you are, Josephine, on it. Okay, so this was the peak in Capex. Can I draw on that one? The 9.88, see that black, the 9.88 number? That's the Capex peak, okay? So this puppy right here, beautiful, all right? This is called a massive acceleration in Capex. So for you, those of you who are not yet rate of change believers, you're gonna believe me, okay? Capex went, phew, and after that, everybody goes, love Capex. I love Capex. Capex is so good. I used to say it up until a month and a half ago. But you know what's happened? The damnedest thing. The rate of change actually in this number, so this is a September number. We're talking about the Q318 number. Within this number, which we got to update this broader chart, you know what the number was? 1.9%. Jonesy, that is the worst number I've seen in a long time. Relative to expectations. So Capex now, is gone to up 1.9 in September against this comparison. The comparison next quarter gets much tougher. The monthly comparison is tougher than that. If you don't know what I'm talking about, you should learn this, okay? The compares, or the comparative base effect period, is going to get tougher. So all things held equal, the most recent data point being a weak one, Capex is going to look slower and slower and slower throughout the fourth quarter. What's that going to sound like? 3M's guidance? Caterpillar? Any of these industrials that are imploding on themselves right now? If you think that they've guided down a little bit so far, wait till they guide down for real. Okay? So Capex has been awesome. I understand why. Tax reform's huge. Look, 94% of US companies are companies like mine. What are they called? They're called pass-through entities. Now, socialists may not like this, and I don't care about that. I'm a capitalist, and I like pass-through entities. So pass-through entities are allowed to, you're allowed to, in this country now, depreciate 100% of capital investment against your net income. Now, I don't know about you, but I don't like to pay taxes. You know, I'm not Warren Buffett. I'm not that founder guy at Facebook either, who's like, I made $500 million, and I think that's too much. I mean, come on. That's how you feel about it. What I feel is that I don't want to pay taxes if it is legal to do so. So what's happened last year is that everybody went, wow, I don't have to pay taxes on that. I'm going to buy a whole bunch of more stuff. I'm going to buy airplanes. I'm going to buy jewelry. I'm going to call it capital investment, whatever they called it. There was a lot of stuff that was bought in the fourth quarter of last year. Now we have to compare against those numbers, and all these growth rates are going to slow against what we call peak cycle base effects.
Okay. Nice work on Twitter yesterday. As I know, you're a little handcuffed to how many bullets you use on an idea. I was able to shorten cover several times using the process.
Cool.
Can you give us the high end of the range to short Twitter this morning, or do we have that?
I can't. I'm not going to get into risk ranges this morning. I'd rather get into like the real meat of things. Plus, my laptop just died, so I'd be like Kramer, just making up a number.
Okay. Is quad favorable to natural gas as a staple?
Say that again.
I guess the question is, there's been a couple questions on natural gas, and then
Yeah.
I guess the view is it considered a staple in the
Yeah.
Quad 4?
Well, that's an interesting question. I mean, well, it's not a staple; it's a commodity. Natural gas is, but it's the only. We're probably getting questions on it because natural gas. We're going in season here with winter. Winter is coming, but it's the only commodity, literally, of the components of the commodity price sample basket that we use to effectively front-run headline inflation. That's why I have these views, by the way. If you look at slide 15 in the current macro deck, our view is that inflation drops by more than 100 basis points from its cycle peak. But natural gas is the one thing that has held out as bullish trend. And that's why you should be asking about it. So I would buy that against a broad-based basket of shorts in commodities or inflation expectations, however you want to show that. And by the way, so that's what this chart's saying is that we think inflation should go, again, this updates daily for real-time data, God forbid. And real-time data says that inflation, which peaked in here, is going to go here. Okay, so the blue bar is our forecast. And if you want to get long-term bonds right, just like Bond King has had a great history of doing, and this is why I think Bond King is going to come my way. All right, he's going to come my way because he knows that when inflation starts to roll over and fall, that's the best predictor of what? Falling bond yields and a more dovish Fed. So that's, ironically enough, and again, I'm not a Republican or a Democrat, I'm a Canadian, green card guy. Green card guy that does a lot of math. This green card guy doesn't care about Trump. I don't pay attention to him. But you will know that he will sound very right for the wrong reasons in the very near future. Because the Fed is going to turn tail dovish after they raise rates in December. Again, if our data is right, you're going to have both growth and inflation slowing at the same time, which is no environment for the Fed to be raising interest rates. And that's probably why the market's getting nervous about it and why he's getting mad about it.
Okay. One other point on natural gas. Fundamentally, inventories are well below the 5-year average, 16% below last year. So you have a favorable fundamental backdrop as well.
We also have one of our favorite stocks. Again, not to give you the whole bag. 90% of our business, by the way, is institutional clients that pay us 6-7 figures a year. And so one of the best ideas we have on our institutional research team, our energy team's, I guess their favorite long, is actually a natural gas stock, which is Range Resources. RRC is the ticker on that. They don't like any oil and gas stocks, thank God.
Keith, if you only looked at the put-call ratio yesterday, you'd hardly know the indices were so negative. Does this lack of fear surprise you, I guess, based on that metric?
No, what does surprise me is so many people still stare at the put-call ratio as a single factor. Don't just look at one thing. If that's all you did is one thing, if the question is, Keith, if all you looked at was that thing, I look at everything. I have a big team, research team, and we look a lot of data. What I was actually looking at yesterday was, if you look at volatility, if you look at Ben Ryan's global volatility update, which shows you volatility across everything, you can see that effectively U.S. equities were trading in the 95th, 96th percentile of historical readings on a 5-year basis.
Okay.
So there was a boatload of vol yesterday, if you look at it the way we look at it. This may not shock you, but I don't stare at old wall metrics. Like, I know that it maybe that thing didn't show you what it needed to show you. But what I look at showed me exactly what, again, I would expect to see on a market decline, which is volatility going into the 96th to 99th percentile of 5-year historical readings across the Russell, NASDAQ, S&P 500, et cetera.
Okay. This is, I'm going to paraphrase this one. This is about Hedgeye and kind of the process, but effectively, the question is, it seems like you're getting better at calling these transitions from Quad 1, Quad 2 to Quad 4. Is that a function of your process and team improving over time?
Yep.
Any thoughts on that? And also, the guy says thank you for helping him out.
Well, cheers. Thanks for staying with us. I know I'm as flawed as a human being as anybody else is, and my process constantly needs to improve and be updated. So hopefully in the future, your process is always better than what it was. It's certainly better than what the process was that I had 20 years ago when I started doing this and I didn't know what I was doing. It's better than it was 15 years ago when my boss would tell me to look at moving monkeys. It's a lot better than when we started Hedgeye 10 years ago because you didn't have the computational power of predictive tracking algorithms that you have today and all the data that we're using, nor did I have 40 people on my research team. Lots of stuff. We've commercialized the process. If you look at slide 54, we now can measure and map across the world where we are and what quadrant, quad 1, 2, 3, and 4, quad 1 and 2 in this chart around the world is, of course, it's green, so it's good. Quad 3 and 4 is bad, yellow lights and red lights. If you try to run one, it's at your own risk. So again, what you can see is that the process has now become completely dispassionate and data-driven. Isn't it amazing that somebody like me, who was never supposed to accomplish anything, has found himself with a pretty damn good process and model? That's not because of me. That's because of my team, and that's because of our process constantly asking itself to improve so that our accuracy gets better and better, and most importantly, that our mistakes are mitigated. That's really what risk management's all about, is not losing a lot of money when everybody else is, okay? Everybody can make money when everybody else is. Not everybody can make money when everybody's losing money. So that's what happened yesterday. Again, if you look at today's early look, we go through, again, dollar was up, short-term treasuries are up, long-term treasuries are up, utilities were up, not relative up, absolutely up. Whereas stuff like semiconductor stocks, the XLC, which we told you to short again a couple weeks ago, which is the new communications ETF, down almost 5% on the day. That stuff was down, 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 and down. So again, accuracy is begetting itself because the process in my team is getting better and better at what they do. Don't expect me to be perfect. I am not. I'm not Bernie Madoff. This is not a made-up process. This is, again, going to be something that has gotten something really right in the very short term. But again, over the intermediate to long term, I think people can see the results, and they certainly speak for themselves.
All right, this is a question about the Richmond Fed Services Revenue Index. Plunged from plus 31 at the end of August to minus 1 in October. And the writer called this an ominous signpost of the strength of domestic demand.
Wow.
Saying that this has never happened.
That's great.
Is there anything to take away from that specific data point?
Well, what people do after a decline is that they start to data mine for data points that reflect either what they're looking for or what they need to see. Yeah. Okay, so again, that's just one of the many data points. Don't forget, in our predictive tracking algorithm, which is, again, how we derive our GDP and an inflation forecast, there are 30 data points per month, 90 per quarter in the US model. So we have 90 different times where we can back check, forecheck, and get our paycheck. That's the way we talk about it internally. I'm a hockey guy. Okay, so again, that's the way that we do it. Is the Richmond Fed index in line with everything else that we've started to talk about? Absolutely. Does it surprise me? No. Am I anchoring on that? Absolutely not. Something you probably read at Zero Edge today. They want to get some people to click on stuff like that.
This is more of a comment, but you're crazy good, get crazier.
Thanks. Jonesy and I have a pretty good story of me getting crazy when we first started hanging out in New York City on the sidewalk one night.
Probably have a few of those.
Yeah, you don't. If that was on YouTube, you would definitely be validated in your view that I got a few screws loose.
I don't know if we've hit this already, but somebody asked if we could go over slide 12. I guess in the daily, probably the daily deck. Not sure what that is.
The daily so Macro Show subscribers get a daily stat pack because everything that we're saying is based on data. Okay, me saying I'm not a Republican or a Democrat is not data. That's a fact. But the actual decision-making tree that we're operating on when we're making high probability bets, again, this is all based on probability. It's not based on certainty. I don't sell that. I sell probabilities. So again, in today's current stat pack, I think the team might throw that up there. But again. Happy to review anything that we go through every single day. Is that capital goods orders that's in there? Yeah, there it is. Okay, so that I already reviewed that. Look at that. Thank you. That's the chart I was looking for. Our subscribers are awesome. First of all, if you're watching this for free, you don't get the stat pack. Sorry, with my Canadian accent. But this is what they get. They are given a boatload of data every day. They're given the empowerment to make good decisions with good data. They ask great questions. They're always ahead of me, most of them, because again, they understand the process. They understand what the next data point means. They understand how important it is to be data dependent as opposed to political or emotional when they're making decisions. But again, if I look at this thing, remember I said, believe me, the Capex number just went down a lot? That's a 1.86 number. I called it 1.9 because I was rounding up. Okay, this was the peak in Capex. It's mathematically impossible to get back above that number. Mathematically impossible to get back ahead of that number in the next 3 months. So Capex, friends and foes, which was a great reason to be long stocks for 2.5 years, especially growth stocks, cyclical stocks, stocks that are associated with Capex accelerated. The data says you got to get the hell out of that after you already should have gotten out of it. But again, isn't it amazing how the best strategist on Wall Street is definitely not me. It's Mr. Market. Mr. Market's been pounding those industrials, pounding crazy train, crazy horse. Let's get crazy.
How long do you?
Crazy Horse once said. You guys know who Crazy Horse is? You know,
Yep.
he's from Alberta, right? He would know.
I know all things Native American.
Crazy Horse said, "It's a good day to die." That's what Crazy Horse said, because he was happy with everything that he'd accomplished and everything, and the sky was blue. And if he was going to go down fighting that day, then he said that was going to be a good day. That's crazy. That's why they call him Crazy Horse.
This is a question we've actually had a number of times from institutional subscribers. But blue chip MLPs, are they utility-like? So, thinking of like the higher graded.
Depends.
MLPs.
I mean, what you're really looking for here, if you look at slide 8 in the current playbook, and you can see on the right side the factor exposures that you want to be long, whether it's an MLP or it's a consumer staple stock or it's a big pharma company for that matter. What you're really looking for isn't the sector exposure on its own. What you're looking for is the sector and the factor exposures. So if you're looking at an MLP, hopefully it's got a high dividend yield, or it wouldn't be an MLP. It's a low beta stock, which not MLPs are. A lot of energy stocks are high beta stocks right now, so you wouldn't want to be long those. And again, it's got low volatility. The high dividend yield part, which I think we have more credibility than anybody on Wall Street on this, you got to do your financial, research on the accounting of what is that yield. Is it a safe yield or is it a fake yield? And this is a lot of the fake news in MLP space, which we went head-to-head with CNBC and their bozos on this. Remember Lynn Energy, we called it a zero. Atlas Energy, which was another one of Leon Cooperman's great ideas, not so much. I mean, these were companies that were literally making up numbers effectively to pay a dividend that was fake. Okay, so you got to be careful in the MLP space. We know that. If you want to look back on the research that we've done, I would highly encourage you to do that. But you got to do your research once you get into these factor exposures that we want to hold. Okay, so we already told you where to fish. But again, ideally, to catch the right fish or the right kind of fish, if you don't want to catch some greasy pike and you want to catch a beautiful walleye, you have to use the right lures.
All right, Keith, I have no process questions this morning. Been a loyal subscriber for almost 2 years. I have 18 years in the business. I've learned more in the last 2 than the first 16. Thanks to you and your team for everything you do. Making money this week is too. I do have a question about Keith's weight. I've noticed the change in the second derivative of how many times it's mentioned on the macro show. What are you doing about it? Remember, weight happens slowly and then all at once.
Oh, that is so true. It is so true. I'm getting fatter, but I'm focused on it, obviously. So I'm going to try. My wife's got me on it. I'm going for it. I'm going to knock a couple LBs off in the next couple months. Rate of change is going to start going delta positive for me in that regard.
What countries do you like? What countries are you more favorable on in terms of heading into Q4 and Q1 of?
Oh, that's easy. If you look at slide 54 again, you can see where we see the green is where we get positive. But again, we're not just using that one thing before you get all hot and horny on this. The reality is that we also overlay this with a quantitative signal. So for example, Germany is about to go green, but the data that we just got this week is red. So the probability of those green ones in Germany turning red is high and rising. Okay, so that's the whole point. If you wake up, God willing, like I do, 2 feet on the floor every morning, my number one attribute is that I can grind. It's not that I'm smarter than anybody else. I'm certainly not, I don't have more gravitas than anybody else. God, everybody knows that. And I'm getting fatter, as you pointed out. But at the end of the day, I look at that data and it changes every day, so I change with it. And then I run my quantitative signal beside it, because we have a fundamental research process on that screen behind me. And we have quantitative signaling, Mr. Market's view, beside it. And it's a constant debate between those two things. That's what I do, and that's how we're going to be starting. The first place for me to look, of course, is in a place that has a green 1 developing after a series of red 4s. Red 4 is called quad 4. That's why we say quad 4, get the hell out of a lot of risk, which includes high yield, credit, anything that's oriented like high beta, high momentum multiple stocks.
I've had a couple questions on this. Do you plan on expanding Hedgeye University?
We could if we had some more dough. For those of you that don't subscribe, and we'll create more products with all the money that you pay us. So I'm not a bank. Again, I'm not one of these, we called the crash, we didn't get bailed out by the crash, okay? So there's a lot of things about this place, one of which I don't have a private equity investor, don't want one. We are fully funded, and I built this place with my own money, and that's what it's got. So everything that you want to see is a function of everything that we build together. And we reinvest everything that you pay us back into the business. If you can't see that, you haven't been following us long enough. So again, would love to build out the educational products. I think that that's it's probably actually in terms of feedback, the number one thing that we get in terms of people wanting more. Everyone wants to learn. Not everyone wants to tell you who they learned it from. I'm okay with that. It's totally cool. We have a lot of subscribers who are actually anonymous. We have a lot of people that don't like me that subscribe. We have a lot of people that really like me that subscribe. It's not about that. We're learning together because we're, unlike the old wall, not able to not learn faster, okay? If we screw up, you don't pass. If we screw up and screw up and screw up, we're a screw up and we don't exist. So again, that's how we're going to keep pushing the envelope on this. Look for more and more educational products because again, that's what you're asking for, and admittedly, that's what I want to create.
All right, have a number of questions on this topic as well. Can you comment on healthcare stocks, XLV and even PPH performed poorly the last few days? All the other positions have been great, but I can't understand the reaction of healthcare stocks.
Well, you should be able to because they both, so when PPH, when we sold it in real-time alerts, if you're not a subscriber to that, then you're not getting all the pieces of information, right? So when I sold PPH, I said, look, this signal doesn't look like the playbook. So the playbook is one thing, right? Everybody on Wall Street wants shortcuts. That's why they use 200-day moving monkeys. That's the ultimate wrong one thing. But again, the playbook says healthcare stocks should do well. Playbook says that big pharma should do well. But the PPH didn't signal well, so I sold it. So I mean, and I also said multiple times in the last 2 to 3 weeks, when I look at the things that should act well in quad 4, of all of them, so let's take the 4 sector exposures that look good. Utilities was looking the best, number 1. So again, there are 4 different things that we like. I have 4 kids actually, so here's a good analogy. I don't like their behavior all at the same time every day. And I'm very vocal about that. My wife doesn't always like that. But again, I'm a disciplinarian, as you might imagine. And if their behavior sucks, then they're going to hear about it. All right? So if utilities acts beautifully, like my daughter Lucy has been acting, she's awesome. She's my third child. She's great. Okay, so that's utilities. She's acting great, so she's going to get a lot of good stuff and a lot of good treatment from daddy. And then the second one has been consumer staples. So that's more like Reese. She's my 3-year-old. And she's like 3, so she doesn't know it better. And I got a lot of patience for her. So healthcare is more like, I'm not going to tell you which one of my other 2, but that they're the older ones. The behavior's been quite dicey lately. So they don't get to play Fortnite. They don't get to do this. They don't get to do that. And PPH in healthcare, which has fallen down that way, doesn't get into daddy's portfolio. I have a choice. If you could audit my PA, which you can't because my computer just died, because this is the longest macro show we've had in a while. You will see that the number 1 position in terms of size is short-term treasury bonds, which I bought last week. Hit it in real-time alerts. I had to hit it before I sent it to you. That's so that I'm not front-running you. SHY, that's the number 1 position in terms of capital, followed by number 2 utilities, followed by number 3 TLT. There is no healthcare in there. Bad behavior. Bad behavior. The quantitative signal, please do not ignore Mr. Market's view of this. Using just one thing, like having 4 beautiful children that should have beautiful behavior all the time, not a reasonable assumption.
All right, I think that's a wrap. Thanks everybody for tuning in. Back at it tomorrow morning.